Oh, well, if you ask me to describe them, I mean scrumptious, tender, pops in your mouth. I mean, really, you are a craftsman. All right, I know you've got to go. Busy day, I hope you take care. All right, bye-bye. Johnson, besides wasting my money, what are you doing on your future box there?
No, sir. I was just looking at some sausages on my phone. That's what I was doing. Yeah, what were you doing on your phone?
I was just talking to my butcher about his sausage.
I talk to people about sausage all the time.
I mean, sausage is a very good food. I wouldn't knock it for the world. Wisconsin, good sausage country.
Best sausage in
Oh
America.
my gosh, the northern parts, that bratwurst business,
Yes.
Well, what else you got going on there?
Well, I was also talking to a farmer, does hogs. He had a lot of questions about livestock insurance.
He's probably got some fine sausage as well.
Yes, I can attest he does.
Okay, well, Johnson, we've talked about two insurances now. Revenue protection and yield protection. We should talk about three more before lunchtime. First, hail. Second, pasture, range, and forage. And third, livestock revenue protection. Now, Johnson, I think you should go visit this farmer friend of yours and make him a customer. Really play up how great his sausage is.
I will look him and his sausage right in the eyes.
All right, Johnson, I have one more thing for you. The best part of this job are the free flights to anywhere. Isn't this great, Johnson? So, when we think about how does a farmer really protect all of their risk, they've got their beautiful sweeping fields of crops, got some protection for that. Now we've got a barn full of cows and a pen full of pigs. We need to make sure we got some protection on those too. With livestock risk protection, you've got the opportunity to protect between 70 and 100% of the value of those pigs and those cows. Not a bad deal. I mean, I kind of think of it as like the golden cow or the golden pig of crop insurance. 100% protection? Now, it only protects against price loss. So we don't have a death loss. It's not just loss of animals, but market protection. And when we think about how much value that brings to a producer ready to have a really safe and sound business, livestock risk protection is like a one-stop shop. All right, so let's set up some goalposts here. When do we want to insure these sweet cows and tasty pigs? So Uncle Sam sets up some periods, what we call an endorsement period. And typically those are between 13 and 52 weeks.
Okay. So farmers are going to want to pick an endorsement period that matches when they want to sell or when their livestock comes up to weight.
Exactly, you got it.
Okay, because they don't want to be paying for livestock once it's off the farm.
Right, we want to cover that risk when it actually matters. Well, let's take a beat and do some numbers. So if I want to insure 1,000 cows that I plan to sell at 1,100 pounds each, I might choose to insure them at 66 cents a pound at 100% value. Then, if at the end of my endorsement period, the market price for steers is 65 cents a pound, my claim would be for the difference. What is key to note here is that the market price for livestock changes daily, which means that coverage and rates do too. Unfortunately, livestock risk protection can only be bought when the markets are closed, which means it involves lots of nighttime work.
Okay, so I get that livestock risk protection is great for cattle and swine producers.
Bingo, yep.
But what about farmers that have a significant amount of forage, rangeland, or pasture?
Oof, that's where this hat's gonna come in handy. Let's take a little walk. So pasture, rangeland, and forage insurance is for producers who have mostly perennial hay and grazing ground. So when we think about those other insurance products that we've talked about, we're protecting against yield and price and whole farm. That's not this insurance. This insurance, could I see your hat for a second?
Yeah, okay.
This insurance I like to think about as a raindrop, or a lot of raindrops, in that it protects the farmer against a lack of rain.
My hat's so wet now.
Not wet enough, bud. The USDA has the records on rainfall for all agricultural land in the U.S. since 1948. The historical average rainfall for each location is assigned an index value of 1, and the policy pays on a deviation from that average rainfall. The highest and most common coverage level is 90%. So if the rainfall for the chosen time interval and location falls below 90%, a payment will be triggered. Instead of this policy covering an entire year's worth of production like the other policies, farmers actually pick and choose which months they want to insure. Farmers must select at least 2 different 2-month intervals to protect, like May-June and July-August. But they can also choose more than 2 intervals, so there's flexibility in choosing when to insure. They can really tailor their coverage to their climate and their land. A big benefit to this policy is allowing more flexibility than other coverages. In addition to flexibility on the one-time period insured, under PRF, farmers can also pick and choose which fields or pastures they want to insure rather than having to take an all-or-nothing approach. Whereas with revenue protection, if you have a crop on your policy, say corn, then every acre you plant to corn in that county has to be insured. Pro tip line, you got a pro tip for me? I know it is raining cats and dogs out there. That's how I got my Fido. Oh, you do? Okay. Oh, you do have a pro tip? All right. Okay. Yep. Let me tell him. One sec. He says that when the rain is below the chosen coverage index, a claim is automatically filed and paid. So this is a more, how'd you describe it? Stress-free insurance product? Also, yeah. It does not require any yield or revenue history, so it works pretty well for newer producers. Thanks, pal. Catch you later.
Okay, so farmers can get rainfall protection for pasture, rangeland, and forage.
Yep.
All right, but the thing is, where I'm from, there is hail.
Oof, I know, my car's all dinged up.
Yeah.
It's the worst.
So, does Uncle Sam cover that?
He actually does not, unfortunately. So remember that we only have Uncle Sam involved where we have subsidized, federally regulated programs. And so as hail affects revenue or price, it does have some impact.
Okay.
But most folks in the hail belt are going to seek out private insurance. And so that's just where a private insurance company offer a product that you can buy, and it's going to be regulated under the state insurance laws. Now, I like to think about hail as a funny icicle with a cute little tie, because he is unregulated.
All right. Well, you know what, Nate? Thank you so much for all this education.
My pleasure.
But I feel like it is time for me to get home and polish this hat.
Ooh,
if you know what I mean.
Swing and a miss. All right, we flew here. Let's get home a little faster. How about a high five?
High five.
Ah, that's a good high five there, Johnson. Next up, your handshake. But let's not get ahead of ourselves. I realize there's a lot of work to do there. Now, Johnson, I've got some very important work to attend to. Would you mind wrapping this one up for me?
Certainly, sir.
Thank you, sir.
Right, everyone, let's review. Question number 1. What are the 5 types of insurance? Question number 2. Who do they protect? And question number 3. What are the different types of coverage levels? Now, I think I'll leave you in the capable hands of Nathaniel. Well, I'll leave you in the hands of Nathaniel here, and I'm gonna go.